Imagine this. March 10th, 2000. The Nasdaq stock index is soaring, hitting an all-time high of over 5,000 points. 20-something millionaires, decked out in khaki pants and company-branded fleeces, are cruising around in brand-new Ferraris. A company called Pets.com, which is actually losing money on every single sale it makes, is somehow worth a staggering $300 million. It felt like a party that would never end. But what nobody realized was that they were all standing right at the edge of a cliff. Within just 1 year, the Nasdaq would plummet, losing 60% of its value. Within 2 years, a mind-boggling $5 trillion in market value would evaporate. $5 trillion. That's more than the entire GDP of Japan at the time just gone. Poof. And here is the crazy part. This financial catastrophe wasn't triggered by a war or a string of bank failures. It was caused by the internet itself, the greatest technological revolution since electricity. So, how did this incredible invention create one of history's most devastating financial disasters? And more importantly, why are we seeing some of the exact same warning signs today? Let's rewind to 1993. The internet was clunky, mostly text, and used almost exclusively by academics. Business executives were still wearing formal suits with massive shoulder pads. There were only about 130 websites in the entire world. Then, the Mosaic web browser was released. Suddenly, the internet had pictures, colors, and clickable links. For the first time, regular people could actually use it. By 1995, everything had changed. A company called Netscape went public, and its stock price closed its very first day at $58 per share, valuing the company at nearly $3 billion. The catch? Netscape had never made a single dollar in profit. This was the moment the old rules of investing got thrown out the window. Traditionally, you valued a company based on its earnings and assets. But a new philosophy took over. Those old metrics were obsolete. What really mattered was potential, growth, and eyeballs. How many people were looking at your website? The mantra became, get big fast and worry about making money later. And for a while, it seemed to work. The new tech elite even dressed differently. Out went the suits, in came the khakis, button-down shirts without ties, and fleece vests. Steve Jobs made black turtlenecks and jeans an iconic look. The message was clear. We're not your father's businessmen. We're revolutionaries. By 1998, the madness was in full swing. Companies that just added "com" to their name saw their stock prices jump an average of 74% overnight. The Globe. Com's stock skyrocketed 606% on its first day of trading. 22-year-olds in backwards baseball caps were being handed millions of dollars to build businesses based on plans scribbled on napkins. The business models were insane. Webvan spent $800 million setting up a grocery delivery service that lost money on every single order. A company called Cosmo.com would deliver a single candy bar to your door for free. Pets.com spent $1.2 million on a Super Bowl ad, all while losing money shipping 50-pound bags of dog food. But investors didn't seem to care. Venture capital funding exploded from $3 billion in 1995 to $48 billion by 1999. Then came the breaking point. In January 2000, 14 different dot-com companies each paid over $2 million for a Super Bowl ad. The executives watching from their luxury boxes, clad in their branded fleeces, thought they were invincible. On March 10th, the Nasdaq peaked. Just 3 days later, it started to fall. There wasn't one single trigger, no big crisis, no bank failure. Investors just started asking a simple question. Wait a minute. When are these companies actually going to make money? And nobody had a good answer. The spell was broken. These companies had always relied on raising money from investors to fund their growth. But that required infinite confidence, and suddenly, that confidence vanished. The fallout between 2001 and 2002 was brutal. Pets.com shut down just 9 months after its big Super Bowl ad. Webven burned through $800 million before collapsing. eToys went from an $8 billion valuation to bankruptcy. Those cool Silicon Valley offices, once filled with foosball tables and free lunches, sat empty. The iconic Aran chairs that cost $1,200 were being sold for $50 at liquidation sales. But the real victims weren't just the tech brothers. They were regular people, teachers, nurses, and construction workers who had invested their retirement savings in tech mutual funds. They watched their life savings collapse. The Nasdaq ultimately lost 78% of its value from its peak. Now, here's the uncomfortable truth. We're seeing some of the same patterns today. In 1999, venture capital funding hit $48 billion. In 2021, it hit $330 billion. The fashion has changed. Hoodies and Patagonia vests have replaced the khakis and fleeces, but the blind optimism is identical. WeWork was valued at $47 billion while hemorrhaging money. So what can we learn from this? First, a revolutionary technology doesn't automatically create a profitable company. The internet was revolutionary, but that didn't save Pets.com. Second, when everyone starts saying, "This time is different," it almost never is. Every bubble has a story to justify it, but the psychology is always the same. And third, the best time to be skeptical is when everyone else thinks you're crazy for not joining the party. The people who sold their tech stocks in early 2000 seemed foolish at the time, but they're the ones who saved their fortunes. The next bubble is probably already forming. The only question is whether you'll see it coming. Thanks for watching. If you want to understand the patterns of financial history, make sure to subscribe and leave a comment below. What modern trend looks the most like the dot-com bubble to you? Stay skeptical